Hello everyone. In this video, we'll talk about how 2025 can go. So how much return we can expect in 2025 that we'll try to analyze based on the past 10 years data. So on the first slide, we have return for for 10 years for different indexes. Like it is having sectors, having factoral indexes and basic indexes like Nifty 50, 100, 200 and other indexes. So currently I have sorted based on which is giving the highest average return considering the 10 years. So Nifty Midcap 150, Momentum 50 has given the highest return of 20.88% on average. So it is the first, then second is Microcap, then Nifty 200 Alpha 30 which is having 19.32% return, then Alpha 50 Momentum, Nifty 500 Momentum 50. So from top 5, the 4 is having Momentum and Alpha based and 1 is Microcap. So we can see that on an average, Alpha or Momentum overall on a longer term works better compared to the other strategies. We can see in this next slide that standard deviation. So which is so I sorted based on which is having lower standard deviation. So the Nifty 50, then low volatility indexes, Nifty 100, then FMCG, which are the 5 indexes having lower standard deviation. So obviously we know that is why we invest in Nifty 50 and Nifty 100 stock, because of they give consistent return more of a compared to the small cap and mid cap and micro cap indexes. So the same is also seen from the data that Nifty 50, 100 and this low volatility index is having lower standard deviation. But the problem is it is having lower average returns. Like the average return which we seen in terms of other is nearly 20% around, but here it is more of 10 to 12%. So the return is less, but the standard deviation is less also. But there is another thing which we can see to balance out between return and standard deviation, that is Sharpe. So if we see the Sharpe ratio, which are the indexes which is having higher, then we can see that Nifty 500, the low volatility 50, then low volatility 30. So again, which is having lower standard deviation, that gets the priority because it's divided by the lesser standard deviation. But the other thing is Nifty 100 Alpha, which is having almost like 15%, so which is in between the higher end to the lower end of maybe 10-12%. But at the same time, the standard deviation is also less. So this kind of index is having high risk adjustment return. So it's not the best return available, but it is not the lowest return. So it is in between, and the risk adjusted returns are quite good. Now, if we see how is generally the returns are distributed based on the market cap. So Nifty 50 and 100. So it is more of a more market cap kind of like Nifty 50, which is having the biggest 1 to 50 number stock. So that is having the lower such average return than Nifty 100, then Nifty 200, 500. So this Nifty small cap 50 is exceptional case. Otherwise, generally it goes in the same way like Nifty 50, 100, 200, 250 total market. And then micro cap with the highest return, and mid cap and small cap are in between, and also next 50 is in between returns. But micro cap having highest return, but at the same time it is having the highest standard deviation. So the risk is quite high. Risk in the sense there can be years where there is the returns are quite negative or very negative, like you can see it in terms of 2018 and 2019. So in that 2 years, the returns are quite like minus 32%, minus 27%. And if we take the first 5 years average, like 2015 to 2019, then the average return is just approximately 3.8%. So the problem is with this kind of high standard deviation indexes is the returns are not predictable. So the problem is we will not stick with the strategy, because for few years if we don't see any return or maybe negligible return compared to the other indexes, then we'll switch. Then later on when the returns start to get, we will have another index or another strategy that we are following. So the problem with higher standard deviation is we will not able to remain with the same strategy or same index for longer term. That is the main issue. Otherwise, it can give the highest average return. So this is all the basic idea about how different indexes have performed and which is having the higher return and standard deviation and market cap and other thing. But the main thing that we wanted to see is what we can predict for 2025. So for this, this is the basic indexes, all the indexes, and these are like the red is below average return years. So Nifty 50 has a total average of 10.49%. So which are the year like 2024, 2022, 2018, 2016, 15, which is having a lower than 10.49, that is marked red. So same way for all the other indexes which is having lower than their own average, which is marked red. So as you can see clearly here, most of the time 2015, 16, 18, 19 and 2022, the returns are below average in these 5 years, and the other years the returns are above average. So what we can see here is in the beginning, like 2015-16, there has been 2 years which is having below average return. Then 2017 which is having high return. Then again 2 years which is having below average return. Then again 2022, 2 years having good return. Then 1 year again having below average return. And again 2 years having above average return. So based on the sequence, how above average years and how below average years are going, because in 2022 there has been below average year, then for the 2 years we are having above average years. So most probably in 2025, there could be a chance that we can see below average year, because it's the same pattern like earlier. It was coming in maybe 2 years bad and then 1 year was good. But from last 5 years, it has been 2 years good, 1 year bad, 2 years good, and then maybe 1 year bad. So the chances of one again above average year is quite less. So there is always a possibility that the pattern will be a little bit different than the earlier time, but the probability of having a bad year or maybe below average year is quite high compared to having above average year. The idea is, if we believe or if we think that there will be a below average year, then the main point is we want to know that which works in below average year. So here we have just taken below average year data. So from this data, if we can find out there are any of the indexes which can works or which is giving above average return all the years or good return all the years, then we can maybe invest in that, or maybe we can plan little bit portfolio strategy based on that. So in case if the year is not good, then also we can get better return. So that is why in 2015, 16, 18, 19 and 2022, we have kept. So what we can see is average return is from Nifty Energy. This is having the highest return. Others are in negative also, like Smallcap 50. But like Nifty Energy, which is having the average return of 8.62%, then Financial Service Bank, Oil and Gas, FMCG, and then all the low volatility 50, then alpha low volatility 30 and other indexes. The maximum return on an average we received is 8.62, then 7.83 and then 7.31. So now there could be one strategy in which we can maybe invest in maybe FMCG, bank, financial service, energy, and this way. Or otherwise we can invest in low volatility, or we can combine that low volatility and low volatility, alpha low volatility 30 and all the other indexes, and we can find best risk adjusted the stocks from that and we can invest. But the main point here is like if we get maybe the chances of average return is 7.3, or maybe top 3 are having 7 to 8%, then maybe in between that we can also get fixed deposit return. So rather than taking a risk, why we cannot invest just in maybe some bank fixed deposit or some other way which is having a quite safer return or fixed return compared to the taking a risk. So one of the other idea could be we can take some of the money and invest somewhere else. If we think that 2025 would be having a lower year, if we believe based on some data, then that could also be an option. And if we have to invest, then the other option could be we can have in defensive stocks. But it all depends upon we believe that 2025 will be below average year. But if let's say again there will be a one good year, which maybe the pattern will be broken and there will be again one good year. So then if we invest in this kind of low volatility and safe indexes, then the chances of getting high return would be lesser. So the other option that uh, can be possible is like investing this kind of like Nifty Alpha 30 or Nifty 200 Momentum 30, which is having not very bad return in the average years, but it also having good return in the good years, like above average years. So that way, in case the year is good, then we can get a good return. And if the year is bad, then also it will not having so much dent. Then again, we can see some of the factors like this factor which is equal weight. So the problem is if we are making our own indexes based on momentum alpha or any of the our own strategy, then one of the problem is how to weight how to give how much weight to the particular stock. So there are three indexes which is having different weight and also having equal weight stock. So like Nifty 50 equal weight, then 100 and 500. So if we can see their average return, and if then we can find out whether having equal weight or having the particular weightage to a stock would make any difference in the long term on the output. So we can see on an average the return for all three are nearly same as the index. So it means if we have equal weight or it is having like different weight based on whatever formula we want to use, then the returns are nearly same on the longer term. But the problem is it will increase the standard deviation. So we can see in terms of Nifty 50, the standard deviation earlier was 9%, but after equal weight it is having 12%. Then for Nifty 100 it was 9% for Nifty 100, and then equal weight having 13%, and then Nifty 500 is having 11%. Then it has increased to 21%. So the main issue is there will be few years which is having very good, but few years which is having very bad than the index. Then we have some data for like alpha momentum and low volatility. So these are the indexes and their base index, like this is Nifty 100, and then there are two indexes which is Nifty 100 alpha 30 and Nifty 100 low volatility 30. Same way for Nifty 200 and alpha and momentum, then 500. So what we can see is Nifty 100 having average return of 10.83%. But if we use the alpha and select the 30 stocks, then the return would be 15.47% with a little bit higher in standard deviation. And if we just select the stock based on low volatility, then also return is maybe 1% higher and having the same standard deviation. So in both the way, like if we select alpha or low volatility compared to the standard index, either it will give higher return or it will give a higher return a little bit with the same standard deviation. So alpha and low volatility both beat the normal index. The same could be for Nifty 200, like Nifty 200 11.4%, but alpha and momentum both are nearly 19% and 17% return. Same way for Nifty 500, low volatility 50 having also lower volatility, but at the same time higher return. And for momentum 50, very high return with higher volatility. Same way for Midcap 150, quite high return compared to the index. Then same momentum quality 100 also having higher return. So the idea is alpha, low volatility and momentum mostly always works. Then we have some of the quality, value and free float. So like Nifty 100 and Nifty 100 quality 30, what we can see is average returns are nearly the same. Also little having higher standard deviation. Now for 200 also quality having nearly the same return with nearly the same standard deviation. Then for mid cap also like 16% for mid cap 150, but 13.30% for quality 50 and a little bit lower standard deviation. And for small cap 250, it is having a higher return. So except small cap 250, for all the other indexes, quality 30 has not given higher return. So the quality can work sometimes, but doesn't work sometimes. So if you see value for Nifty 200, the return is lesser, and also Nifty 500, the lesser the returns are nearly the same, which the quite high increase in standard deviation. So based on this initial data, we can believe that value also doesn't have much of the use because it is also having a return which is nearly the same, the basic index, but it is increased the standard deviation so high. But if we see the last 5 years data for the value, generally we can take any years of data for our calculation purposes. I have taken 10 years data, but you can take 5 years, 10 years, 15 years, 20 years. There is no as such rule. So if someone takes the 5 years data, then value would be quite good, because in 5 years, last 5 years, value has done considerably well compared to the index. But because earlier it was having a bad time, that is why in 10 years data the average is quite less. But in recent 5 years, the value is also doing good. And in terms of free float, like Midcap 150 to Midcap 150, Midcap 150 having the highest return, and the same way Smallcap 250, the basic index has the highest return. Smaller indexes from the bigger indexes doesn't serve any purpose or doesn't give much of the value addition compared to the bigger index. So these are the other factors in which, like, we have one alpha 50, then alpha low volatility 30, then quality low volatility 30, then alpha quality low volatility 30, and then alpha quality value low volatility 30, and again separate just for low volatility 50. So what we can see is, again, alpha having the highest return with higher volatility, means standard deviation, but the returns are quite high. At the same time, alpha low volatility 30 has a comparatively lower return, but with so low standard deviation. And there is one more index which is quality low volatility 30. So again, we can see that average return for alpha is quite high compared to the quality, and standard deviation is also lower in quality, but then also return is also quite low. Then if we see the alpha quality, then also it is not having like it is having the same standard deviation as the alpha low volatility, and the return is lower. So again, adding quality to the alpha low volatility would not make much of the use. And then if we add the value, then it is having nearly the same return as a little bit higher return than the alpha low volatility with nearly the same standard deviation. So idea is quality does not help much. Value helps sometimes. Alpha always help, and low volatility, like we can see that Nifty low volatility 50 index, which is having the standard deviation quite low compared to the other indexes, but also having above average return. We can conclude from all the data. So one is alpha and momentum generally gives higher return from the top 250 stocks. Microcap also give higher return, but it is having higher volatility. Now, if you believe that 2025 would be a below average year, then investing in low volatility in the index or having the sectors like FMCG, energy or financial service would reduce the risk. But if we think that we just want to keep the same strategy for all the years and we don't want to do anything different for 2025, then we can go either with Nifty 100 Alpha 30 or Nifty 200 Momentum 30. So which can be a good choice because it balances between good year and bad year. So we don't need to keep changing the strategy based on our guess. Then alpha, momentum and low volatility almost always work. Alpha and momentum gives higher return with increased volatility, whereas low volatility gives slightly better return with nearly same volatility compared to index. Quality mostly not works, as we have seen in the data. Value work in last 5 years, but considering 10 years, the returns are nearly similar to the index and volatility is quite high. But in last 5 years, value has done quite good. The midcap 150 works better than midcap 50 and 100. And the same way, small cap 250 works better than small cap 50 and small cap 100. So that's all for this video. Thanks.